Everybody, welcome to another episode of Through the Lens. I'm here today with Matt Graham. He is the CEO and founder of MBS Live, Mortgage News Daily. He is a CNBC contributor and a daily therapist to hundreds, if not thousands, of LOs through his website marketplace. Personally, MBS Live is a site that I've used, I think, almost 13 years now. A great deal of my team uses it as well. It's invaluable for us as we make determinations what we're going to do with our clients and to help them with valuable information. It's an awesome marketplace to share ideas. So welcome, Matt. Thank you so much for coming on here today.
Yeah, thanks for having me.
Perfect. So with ever fluctuating real estate trends, mortgage rate landscapes, let's dive right in. So what's your crystal ball prediction for the next big shift in rates, and what could possibly cause that shift in rates?
Yeah, I love crystal ball predictions, and the interesting thing about them, especially post COVID, is that people thought they saw a shift in rates, a ceiling, and a move down a couple times now, and some people thought they saw it like pretty convincingly, only to be very wrong. And right now, it's an exciting time to have this podcast because we're just getting into this 2 week time frame where it looks like we have another shot at seeing that kind of shift. It's the kind of thing that's going to take probably a couple months to confirm, but it could be the early signs right now. And it'll be hilarious to watch this in hindsight and see if it happened or not, because if it doesn't happen, rates could end up going quite a bit higher. And if it does, then we'll look like geniuses. And we can say, yeah, I predicted that rates would go lower back then. But no, you can't really know. If I had a crystal ball, I would say, oh man, you're going to put me on the spot with that. I really, third time's the charm. Let's say third time's the charm.
Yeah.
But we're going to have to muddle sideways for a bit before we can really confirm a move lower in rates. Things that could spoil that assessment would be the data over the next 3 days specifically, and what the Fed has to say tomorrow afternoon. So if certain economic reports were to come out stronger than expected, then that's going to make the market and investors think, gosh, we're not seeing the kind of economic weakness that we need to see in order for rates to go lower. And so rates are going to have to keep going higher.
Yeah, I think mortgage rates for most people, not you and I, but a lot of people, it's like a black box. And I think the average consumer doesn't really know what drives interest rates. And I think a lot of people just kind of want to know, like, what is the primary factors that drive interest rates on a daily basis? What's pushed rates up early last year? Really, what drives this?
Yeah, that's a good question, and a question that you could answer with incredible detail. So I'll try to keep it as simple as I can, because you could really write a book on that. But in a general sense, people think about things like the economy, economic strength, and inflation. And realistically, whatever is driving bond yields, when we talk about bonds in the US, the most vanilla kind of touchstone would be US Treasuries. And a couple different things can affect those: economic data, inflation, but also supply. So if the government is issuing more debt, that can push rates up. And that's a hot topic this week because we got a new announcement of government Treasury issuance. So when economic data is stronger, when the economy is stronger, people have more jobs, are making more money, spending more money, then that puts upward pressure on rates for a variety of reasons. Number one, a strong economy is better able to sustain higher rates. Number two, if inflation is rising as a result of that economic strength, then rates would be rising in order to combat inflation, because the Federal Reserve uses its policy rate, the Fed funds rate, to push back against inflation when it sees it moving too high. That doesn't directly. Go
Yeah,
ahead.
yeah. Sorry. So right now, so how did we get here today? Right. So 8%. Actually locked somebody yesterday 8.625. Fairly good borrower. The end of 2021, 22, early 22. People were predicting 4% rates, right? And predictions are pretty wild, right? I mean, they're hard
Yeah,
to predict. Um,
especially
housing
about the future.
Yeah, exactly. That's Yogi Bear, right? It's his quote. So, how do we get where we're at? 8% rates, all time low of affordability. Housing inventory is scarce as ever been. What led us to this spot that we're in today?
Ooh, good one. Specifically with respect to inventory stuff, and I think you guys have seen this and probably know it. It's really hard to get people to want to list their homes when they're locked in at 2.5%, 3% mortgage rates, and so that's hitting inventory really hard, a lot harder than most people realize. But I think people have sort of started to accept that as a contributing factor. But as far as what pushed rates up in the first place, a combination of factors that probably wouldn't have ever existed without the pandemic. And you can talk about supply chains pushing inflation higher, but you also have to talk about all of the money that was dropped on the economy, people being able to do forbearances, student loan forbearances, super low mortgage rates, helping people save money on their monthly payment there, and just an influx of cash in an attempt to mute the ill effects of lockdowns and things like that. So noble causes, right, and justified concerns. The Fed kept saying, "Hey, we really want to make sure that we are giving this economy a tailwind coming out of the pandemic and coming out of lockdowns." And so they maybe overdid it a little bit. By their own admission, they say they overdid it in 2021, especially. And so all of that stimulus, all of that push to sort of make the economy, hey, look, you can go move on from COVID, pushed prices and economic growth so high that now rates have to be high to stifle economic growth and prices. It's sort of like making things more expensive so that they can get cheaper again, which is sort of a cruel joke for people looking for mortgages right now, but it's the only tool they have.
What do you say to people that blame rates on one political party versus the other? I personally don't think they're so associated, but what do you say to people that? I guess second part of that is a lot of people think that next year we're going to see a sudden rate drop because there's an election year, and maybe the president has some sort of undue influence over the Federal Reserve and interest rates. What do you tell people when they say that?
Yeah, this comes up a lot, and I'm like you. I don't assign a lot of significance to that. You can make a case for it depending on how political you are, and people certainly do make cases for it. I don't know that they're especially strong cases, and they're generally able to be argued the other way as well. So as far as rates dropping in 2024 because it's an election year, no, I think rates if rates drop in 2024, you'll be able to look at economic data and inflation data and say, oh, that's why rates are dropping because the data reflect that. Presidential administrations, while they are part of the government and while many of these economic reports are also coming from government agencies, presidential administrations have historically proven to have really no capability to distort the data for their own personal benefit.
Yeah.
Or if they could, they've really done a lousy job exercising it, because there have been a few times reports have come out that have just been terrible for sitting presidents, to the point where if they could have manipulated it, they definitely should have.
Yeah.
And I think the key argument right now when it comes to politics and rates concerns spending, the fiscal side, and treasury issuance. And that cuts both ways, because if you go back, definitely we're spending a ton of money right now. Deficits are increasingly talked about as being a driver. They're not the biggest driver of why rates are high, but they're a contributing factor that deserve to be talked about. I just think people should probably tone it down on saying that's the only reason. But for all of the criticism of that, and it deserves criticism. We shouldn't spend as much as we do. If you go back to 2016 and see what happened after that presidential election, it wasn't so much about Trump as it was about the GOP having full control of House, Senate, and Oval Office, and being able to deliver tax cuts. And you had multiple GOP congresspeople on record saying, yeah, we have to deliver these tax cuts for our donors. We have to take care of them. And the tax cuts lowered revenue. And so when you lower federal revenue, you have to offset that by issuing more treasuries. Issuing more treasuries increases the supply of treasuries. Then supply demand 101 means higher supply, lower prices. When you have lower prices for treasuries, you have higher yields for treasuries. Higher yields equate to higher interest rates. And so it put immediate upward pressure on rates. First off, right after the election, due to anticipation for this. And then again in early 2017, when the tax bill actually started to take shape. So, you can increase spending and that's bad for rates, or you can decrease revenue and that's bad for rates. Two different political ideologies, but both doing the same thing.
Yeah. So on your MBS live on a daily basis, there's tens, hundreds of LOs chatting and from all over the nation, right? I think what I don't know how you do it, but you've been incredibly disciplined in not trying to predict the future and
Yeah.
not try to make it and try to take the politics out of it, which I think these things naturally end up getting somewhat political. So first of all, kudos on doing that. And I think we earlier said, it's what is it? Predictions are hard, especially about the future. But how do you not insert your opinion as much as you possibly could, especially when an LO like myself, a lot of us are looking for some sort of like guide into the future. How do you avoid doing that? Because I think it could be problematic if you did that all the time. It's probably the reason why the site works incredibly well is that you don't. But how do you avoid it? Because I don't know if I could.
Yeah, no, I mean, I think it's irresponsible, and maybe it's conditioning from starting this company during the Great Financial Crisis, and maybe that's humbling. I think that the post-COVID market's been humbling because I didn't see 8% interest rates a year ago, definitely, and I told people that on the site. I didn't see that happening. But look, you got to understand, like, if anybody could know something about the future of rates or the market with certainty, with enough certainty to like actually make that prediction and recommend that other people act upon it, then the market would trade that. Billions of dollars would act upon that instantly if it was that clear, if you had a crystal ball. And when they acted upon it, then there would be no more crystal ball because markets would adjust to whatever that prediction was. And then there would be no more advantage to thinking you knew that ahead of time. So to pretend like you can predict the future is really, you're trying to make a lucky guess. Or you're saying that the financial market is not efficient and that traders are stupid and they don't know as much as you and they don't even know what the internet link that you posted your analysis on. Otherwise they could read it and trade it and it wouldn't be worth anything anymore.
Yeah. So you used to be an originator, and then you got out of originating into starting this. What was the journey and what was the decision making process to start that entrepreneurial journey into starting what has became, I think, you have a few competitors out there. From what I've seen, this is by far away the best site that offers this data. But what was that decision for you? How'd that look?
I mean, that was a panicked decision because it was either decide to have a highly variable income, trying to be a onesie twosie loan officer in 2007, versus sort of pivot from this MBS commentary that I've been writing on Mortgage News Daily and turn it into a business that had a stable income of subscribers like yourself that would, it was a smaller income, but a more stable one. And that's what I wanted at the time. And once it started, it sort of took on a life of its own. One thing led to another. And I really found that I loved doing it.
Absolutely.
And
You've obviously done wonderful.
Thank you.
Do you think that this is so I started the mortgages in 2023, July 28th. So I've been
Same.
through, it's quite a few cycles, probably about the same age. Is this the hardest?
Is
this hard as it's been? And
it's harder in a few ways. And I think for the average loan officer who wasn't glued to all of the financial crisis drama in the way that I was, and I mean, I was struggling a lot more as a loan officer back then too. So it was especially traumatic in those days. And I really felt like it was the end of the world at times when I was reading between the lines of what Hank Paulson and Bernanke were saying. Yeah. So, the movies that came out were Hank Paulson saying, I might go to the grocery store and there'd be no milk and then everything would be over. That was like a real concern. So in the sense of the industry completely exploding and not having anything to come back to when it was all over, great financial crisis was worse. With respect to volume and the long-term outlook for rates and how long rates might stay elevated and the potential that we're looking at some sort of new normal where rates don't really ever go back below 5%, which I think is probably too soon to say, this is harder. The nice thing right now is that if you reinvent or double down in the way that you're working, we have success stories on MBS Live, and you see these people chat sometimes about different things they're doing and the way that they're hustling, and it's not the way they want to be working, but it's the way they have to be working to make it happen right now. And so it's doable, and there'll be greener pastures on the other side, especially for people that stay in touch with people that have purchased homes. that are in a position to refi. You want to make sure you're the ones that are getting those refis. Not saying build your business on refi business, because that didn't work out so well over the past few years, but it will be a nice little fringe benefit in the coming years when rates start to come down.
Absolutely. The thing about it is we're experiencing quite a bit of refi business right now because a lot of people are just drowning in debt, and that's the only opportunity they have to save money. So it's a little bit of a bright spot for our company, but I
That's
realize
good.
it's overall not for most companies. I think a lot of it comes back down to housing affordability. And I guess one thing I wonder is, how do we increase affordability without manipulating the financial markets like we have in the past? And is that even, or is that just something that doesn't exist anytime in the near future?
I don't know if I feel completely qualified to give a thoughtful answer on that, because I think things are involved that are above my pay grade, and things that would need to happen that I wouldn't begin to know where to influence them. But look, the problem is this: they're not making any more real estate, and enough people know that it keeps a certain level of constant demand underpinning the real estate market. And so unless you have something like 2008 where everything might blow up, you're going to have this constant level of demand. As long as rent prices remain where they are, if it pencils or comes anywhere close to penciling to buy an investment and rent it out, and you can cash flow that, that's one place affordability could come from, is if you limited investor concentration, and not just like big companies, but just mom and pop investors that have like 10, 20 rentals. Should they? I don't know. Maybe some of them should, but maybe not everybody should.
I mean, should corporations own 50, 100 million, whatever it is, houses, and that's a part of the thing is all these BlackRock and KKR and, a million houses. That certainly doesn't help, but it's
big problem in some geographies and like a non-existent one in some others. Yeah. But both places still have affordability issues.
What assumptions right now do you think most economists might be making wrong?
I think I don't know if I'd say most economists, but a very popular assumption that is generally passionately argued is that we're unavoidably headed toward a recession.
Yeah.
Maybe we are. I mean, we always are if you wait long enough. But I think they're just looking at it as a function of rates. And we don't have many recessions that I know of that have been brought about just by rates being high. There's usually another shock, and then rates are pointed to as a supporting actor in that shock. So simply having rates too high for too long isn't a great justification for a recession. I think that's the main thing. If we're going to have a recession, there's going to be some sort of new surprise, or a surprise that some people are sort of talking about right now that ends up being a little bit worse than the majority think. But people should prepare for the possibility that we don't see a recession as soon as they think we are.
What would you tell what would you tell a loan officer right now that was struggling, teetering, loved the industry, but didn't know if there was a viable path forward with where rates are at right now? What advice would you give? Knowing what you know today and yourself, what would you tell
them? Do what you can to stick with it, even if you have to take a second job. But ideally, you find a way to sort of reinvent yourself, get your hands dirty, do the work you don't really like to do, but that you can do if you need to get by, because the ones that are left after this will have all kinds of benefits over new loan officers that are coming into the market. So it's not fun right now. It's not easy for anybody, but there is light at the end of the tunnel if you put in the hard work.
You just got to be there when it happens. That's why I tell my LOs that every day. There's a party at the end. You just got to be there, when it happens. I got 5 lightning round questions for you. Pretty easy stuff. Right. Will the Fed ever get back into the MBS market?
No, I don't think so. And outside of look, can I qualify that? I know it's lightning round. In an emergency situation where they need to do liquidity reasons, like another COVID, they would do it again, but it would be brief, and they would put a limit on it, and they would let the market know.
Yeah. Who would play you in a movie? Who would you want to play you in a movie?
Some sort of AI.
Okay. Gotcha. So the Sisters Burnett commission lawsuit came down the pipeline today. They awarded the plaintiffs for that settlement. Do you
Like
think
one,
things are fundamentally going to change with real estate commissions?
boy, I don't know, man. That's a great question. I don't think they'll change as much as some people think. They got a big, powerful lobby,
Yeah, they'll figure it out.
and yeah, they'll figure it out.
We done with rate hikes? Yes or no?
Yeah, I think so.
Yeah.
Barring the
Last,
unforeseen economic data.
yeah. Last, are we more likely to see 5% rates or 8% rates 12 months from today?
I would guess more likely to see 5% if I had to guess.
Yeah, I appreciate that. So if you could just tell my listeners right now where they can find you on social, but even more importantly, like if they were to go to mbslive.net or Mortgage News Daily, like what they would expect to find and what kind of value they could get from it. Because it's not just for LOs, right? Real estate agents and the common consumer can get a lot of valuable data from this. I just want them to know what they can do to find you and what they're going to find when they get there.
Yeah, mortgagenewsdaily.com is free, and I write a daily article on interest rates there. And then I also publish the daily mortgage rate index, which is probably the best thing that you could follow for a day over day change in rates. Anyone that follows any interest rate index should understand it's not necessarily the rate you're going to be quoted. It's just a way to track how things are changing, and we have to slap a number on it. So we slap, a top tier interest rate on there. Some people are going to get quoted lower if they're paying points or have an aggressive lender. Some people are going to be quoted higher if they have an abnormal scenario or just an imperfect scenario. But that rate index is a great way to keep a track on how things are moving. Daily rate article on mortgagenewsdaily.com. Then for mbslive.net, if you really want to nerd out on the bond market and how that's impacting rates, that's a fee-based service, not too expensive for what it is, if I do say so. But there we interact all day, every day in real time. I'm available in the chat to answer questions. We do analysis. We have live bond market pricing, live MBS prices, and a community of the best and brightest loan officers in the industry that have really transformed it into something special over the years.
Could agree more. I think if you're a loan officer and you're not part of this service, you're doing yourself a disservice. So I appreciate your time today. Thank you so much for coming on, and I just appreciate everything you've done for the mortgage industry.
Yeah, thank you, man. Thanks for having me.
All right, thanks, Matt. Appreciate it, buddy.